And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal. The full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
Hold on, here's up the weight. We're gonna get there. No, now I'm ready. Good morning, welcome to the show. Of course, it is Tuesday. John Penn joining me this morning. Brent Gunn jumping a gun as usual, so here we go. Hey, you know what? It just is what it is. So just play a little more music until we get there. So anyway, all right, good morning. A couple things going on. Obviously, yesterday, very big rally in the market, so we'll talk about that this morning. Article on the website this morning kind of goes through it in more detail as well. Is the correction over, right? That's the big news, or that's the burning question that everybody has right now. Again, not surprising. After you had a 10% correction, everybody gets a little bit worried, so here we are. Kind of going from there. News yesterday, of course, driving the market was, as we stated yesterday, tariff on, tariff off. Now we're starting to hear from other European countries like, well, maybe we'll just take tariffs off, right? We won't get into this whole tariff war with the U.S. because, well, the U.S. is a lot stronger economically and you're going to lose that war. So, it's not a good position for them to be in. So again, not surprising. Again, as we talked about before, the whole tariff issue with Trump has always been stick and carrot. It's not been, I just want to go put tariffs on people and, we're going to go from there. The whole idea was to get a better trade relationship with other countries on a fairer basis. And again, if you go look at VAT taxes, which are value-added taxes or other similar type of taxes, and tariffs, the United States has one of the lowest tax rates in the entire world. And and when you look at other countries, their tax rates and their impact on imports and exports of goods and services from the United States is really unfair on that basis, right? If you're just looking at what if I'm shipping you a good, service, or product, you're adding an additional tax on it on that side, making it much more expensive for international citizens to buy our goods, products, and services versus what they actually cost. So again, it's a non-competitive basis, and that's the thing that Trump has been talking about. And while there's a lot of people that don't like Trump, of course, for a whole variety of just personal reasons, the reality is that what he's working on is just trying to get a fair trade relationship between countries, and that seems to be working right now so far. Again, as these tariffs have gone out, we've gotten responses back from other countries, either providing assistance through monetary support or through fiscal action like securing the border, etc., or through a reduction or repeal or at least a holding off of other tariffs. So again, that's all kind of just working in that way, but that's been a big weight on the markets. This whole tariff issue, this tariff on this week, tariff off next week, tariff delay, April 2nd's Liberation Day, that's all been weighing on market sentiment, right? Because again, as we talked about before, just can't simply price in earnings expectations when you don't know what the tariff rate's going to be, because that adds to the cost of businesses. But with all that said, when you take a look at earnings growth, the earnings are still coming from the Mag 7. They've been under a lot of pressure. If you take a look at the Mag 7 stocks in general, which make up about 36% of the entire S&P 500 index, they're right there at the top, those Mag 7. You get into the Mag 10, right, the top 10 holdings, that's nearly 40% of the index. So those are very, very important. Those companies also have virtually all of the earnings growth for the entire S&P 500 on a relative basis. So again, just very, very important. So because they make up such a large weight in the index, so goes those stocks, so goes the rest of the market, and they were certainly under a lot of pressure. Now we're starting to see a bit of that buying come back in. Yesterday, it was pretty much a Mag 7 day. If you take a look at the kind of the heat map of the markets, it was pretty much all just green in Apple, Google, Microsoft, Nvidia, etc. Those were kind of your biggest winners yesterday. But again, big rally yesterday on that kind of tariff news. We're probably going to see a little bit of sloppiness here over the next day or so, just trying to digest that rally here a bit. But this is just kind of that part of that bottoming process that we've been talking about. So here's what you need to know before the bell. So yesterday we talked specifically a little bit about money flows that were turning a bit more positive yesterday, and that certainly was the case with the follow-through that we saw in the rally yesterday. Markets moved up sharply. Money flows moved back into very positive territory. MACD, the momentum signal, triggered a buy signal yesterday. Relative strength continuing to improve here. So kind of all systems go right now. We've formed a very nice bottom here, challenged it a couple of times, and then came off that support right here at kind of these lower levels. Now we're starting to get back up into some areas where markets are going to start to get a little bit challenged here. And again, when we take a look at kind of just some of just the technical backdrop of this, this is part of the issue that we're going to be working with is this 50 and this 20 and 200-day moving average, which have now coincided with each other. So yeah, we have this buy signal in place from a fairly low level that should give the markets a bit of lift here. Again, this week is end of the quarter rebalancing. We've got $85 billion of pension fund balancing that has to be done over the course of this week. So there's a good bit of buying. If you take a look at pension funds and target dated funds as a combined entity, that's about $125 billion of buying that potentially needs to be done by weekend. So again, this relative strength improvement in the markets, this momentum buy signal certainly suggests that buying is coming into the market along with money flows turning positive. But whatever rally we get here is likely going to be contained between the 200-day moving average and this 50-day moving average. So once you start moving back up here towards 5,800-ish, somewhere in there, If you didn't like this market decline, if that was really weighing on you and this had a lot of pressure in your portfolio, you were really down way more than the market because you've taken on a lot of speculative bets, etc. I would use any rally between here and 5,800 to lighten that portfolio a bit and rebalance and start thinking about a little bit lower risk profile going into this year, because again, we're most likely not through this market environment of higher volatility. If you go back and look at Trump's previous term, right now the markets are trading just pretty much like they traded in the first term when he was in office. And remember, in 2018, we had this trade war that started with China. We had a similar sell-off. The market rallied back, eventually went to new highs, and then we had a 20% correction by the year end, and then the market rallied right at the end of the year and then into 2019. So again, this is kind of where we are right now, is that I would expect this year to continue to be one of more volatility, rallies, declines, as we continue to digest through these different policy actions coming out of Washington that are impacting, that certainly have an impact. There's a bit of a difference between doing a policy that is, based solely on immigration, right? We're going to deal with immigration, whatever it is. That has economic impacts, but it's spread out over the course of time. And so the markets can absorb that. But when you start doing policy where it's related to like tariffs, which have an immediate impact on earnings, the market has to digest that much faster, and that's more difficult. That creates volatility. So if we can keep getting more of this kind of trade war narrative, tariff issue, or any other types of policies that have an immediate impact on what earnings expectations are over the course of the next 12 to 24 months, the markets are going to have a lot more volatility. So again, I would expect to see that this year. So rallies back to these resistance levels, and again, we've got a room here to about 5,800 right now. But back to that level, rebalance your portfolio, reduce risk, raise a little bit of cash, look for value over growth, those type of things. They'll probably help you navigate the markets better this year. Okay, that's what you need to know before the bell this morning. We'll come back, pick up with John Penn, talk about the fact, is the correction over? I got some charts for you. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So Couple of things. Good morning, John Penn.
Good morning.
How are you?
I'm good. How are you?
Good. Very well. That's it. That's the show for the day. Thanks for coming.
Just going to go drink some coffee. Coffee's tasting good this morning, too, by the way.
I tell you what, I am dragging this morning. My
Coffee's
wife,
good.
Yeah, my wife is traveling again this week, so I stayed up a little bit too late last night watching a movie about warships. So,
a movie about warships. Is
Yeah.
this a new movie or is
it was a new movie with Tom Hanks. This was back during World War II, where we had to send ships over to Europe to deliver products and supplies and oil, those type of things.
Yeah.
And so during that time, they would have all these frigates that they would send over, these ships. So they'd be like 20 or 30 of these frigates that were going over, and then they would have a couple of destroyers going with them, because the German U-boats would get into what was called wolf packs, and these wolf packs would hunt, would basically maneuver their way into these groups of ships, and then of course they're all going in a straight line right together, right? They would get embedded in between these groups of ships and then start torpedoing them.
Yeah,
and so the destroyers were trying to hunt these submarines down and kill them. So
I think I've seen it. It's at Greyhound.
Greyhound is the name
It's
of
awesome.
the movie.
Yeah.
Oh, you saw the movie?
It's
Okay.
really good.
Okay, yeah.
When you were talking
So-
about warships and Tom Hanks, it's like, is there another one out? I was getting really excited. But
Yeah, yeah.
Greyhound's very good, by the way.
The name of the movie is Greyhound.
Yeah.
And I stayed up too late watching that last night. So
Easy to do.
Unfortunately, it's on Apple TV. So you have to have an Apple TV subscription to get it right now. But anyway. And I have a free one because I'm on the 7-day trial just to watch that movie.
You just got to remember to unsubscribe.
Exactly.
In 6 days.
Just unsubscribe. Here's your commercial for Rocket Mortgage. No. Anyway. So talking a little bit about the rally, the big question I've gotten over the last, actually the last 2 weeks. One, the first question was, is this correction ever going to end? And then two, as of really last week, starting to get lots of questions about, is the correction over? And there's certainly some technical evidence that we may be seeing that. And again, corrections come and go. And it doesn't mean that just because one correction is complete that you can't turn around and have another correction right behind it. Those are two separate events, but it certainly can certainly happen. But as we were just talking about a moment ago and kind of the technical overview, there are some indicators that are starting to, kind of combine to coalesce that suggests we may be near the end of that. And one of them, of course, we've talked about over the last several weeks, which has been this extreme negative sentiment of investors. And normally, again, we've had a 10% correction, and you now have negative sentiment. You can bring the chart up, Brent. You have sentiment as negative as it is at more severe market bottoms, even going back to 2008. What this chart shows you is this is the bull-bear ratio. So this is the ratio of bullish sentiment to bearish sentiment, and of both retail and professional investors. So this isn't just the American Association of Individual Investors that's in there, but also is the institutional investment sentiment, the portfolio, the professional manager sentiment. It's all in there. So this takes a look at multiple measures of investor sentiment. And so when that ratio of bulls to bears gets below 0.7, that has historically been opportunistic buy points for the markets. And even in 2022, there were several points where, this market would get really oversold. You'd get below 0.70, the market would rally. And again, as I said, doesn't mean you can't have another correction right behind it, right? So we have this rally here, and then we could have another 10% correction this summer, and then we could rally again and have another 10% correction in October, and then rally again into the end of the year, however it works out. But typically, when you get this level of sentiment on the bull-bear ratio being this out of whack, it typically is near more important market bottoms. And again, we just had a 10% correction, and we've got sentiment at levels normally where you're down 15 or 20%. The shutdown of the economy in 2020 certainly engendered that type of sentiment, but we just had a 10% correction. So it's been very interesting because of that sentiment shift and how negative it's been. But let's just go through a couple of interesting kind of technical charts. The first one is the it just shows the market on a Bollinger Band basis. So Bollinger Bands, all those are, as we've talked about these before, they just measure standard deviation. Standard deviation is essentially just thinking about stretching a rubber band. And if I stretch a rubber band as far as I can in one direction, it has to snap back at some point. And and physics says that if I stretch a rubber band in one direction and I let it go, it will snap back an equal distance in the other direction. So when you have these type of deep kind of oversold conditions, you kind of see it in the chart, is that when markets get to the lower of the bands, they tend to bounce back to the upper bands. Not always. It doesn't always happen right away, but typically going back through history, when you get very suppressed on the lower side, you get a rally back to the upper side, which suggests you have a pretty substantial rally from current levels. And at the same time, you're getting that momentum buy signal from a very, very deep level. So you've had a very deep pull down in market momentum over the course of this correction. So again, that provides that fuel for a subsequent rally. Now, the next chart looks at it talks about money flows. I just showed you this earlier, but money flows have now turned positive again. So that suggests that buyers are coming back into markets. And as we talked about before, money flows are one of the most important indicators to watch. So when you get markets that are moving in a positive direction, as long as those money flows are trending positively, you're typically in good shape. When those money flows start to deteriorate or go negative, that's where we want to be bit more cautious. So that's why we watch money flows so carefully, because that just tells you what's happening. Again, the whole market is simply what? Buyers versus sellers. So if buyers are evaporating, money flows are going to decline, and that kind of gives you a good warning sign. But the buyers have definitely stepped back in here, and again, at the same time, we're seeing that increase in price as well. One more chart, and then I'm going to quit boring you with charts this morning. But this is just kind of the culmination of kind of the analysis. So there's a lot of other indicators that we look at just trying to determine what investors are doing. So one thing we look at is the price momentum. Again, as we talked about before, the MACD is a good measure of price momentum. You can look at price momentum itself. Is the movement of price increasing or decreasing, upside or downside, right? So if the speed at which prices are increasing are beginning to improve, that probably tells you that buyers are coming into the markets. And so when you take a look at price momentum, you take a look at breadth momentum, which is the numbers of stocks that are increasing versus decreasing. You take a look at volume. Is that increasing or decreasing? You take a look at the number of stocks on bullish buy signals. And so if you're driving, don't worry about this. The chart is in today's blog post on the website, so you can actually look at this chart in more detail. But this is important because when you look at all these measures, market breadth, volume, price momentum, they're all turning positive. So again, this suggests that, and again, the whole point of this is just trying to find the evidence. Is like Sherlock Holmes trying to determine who murdered, the butler, right? We're just trying to look at the evidence and say, are buyers returning to the markets at this level? And the early evidence of that is yes. Now, does it mean it can't turn lower tomorrow? Sure. Tomorrow morning, Trump could come out and say, you know what, I changed my mind. I'm putting 50% tariffs on everybody, right? And this market rolls right back over. We're very sensitive to that type of data right now. So because, again, it's the impact on earnings. But all of the early anecdotal evidence of this suggests that markets are at least in a position for a short-term rally. Now, the one good thing about this article, and I suggest you go read it, is that we talk all the time about emotions and all those things that lead us to make bad investment decisions. And so I've provided you 12 investing rules from Gerald Loeb. Gerald Loeb was a Wall Street trader, went through the Depression, wrote the book Battle for Investment Survival, wrote another book called The Battle for Stock Market Profits. These books have been considered staples for investors for decades, and things that you should kind of read. But he had 12 rules that he followed on a regular basis. Brent, if you want to try to bring these up, maybe you can get these onto the screen. But these rules, they cover a variety of things, and importantly, from just looking at public psychology. Again, number one rule: look at public psychology. Just what we were talking about earlier. Look at the bull-bear sentiment ratio. Public psychology is incredibly important. Learning to accept losses. One of the biggest issues that I run into with investors on a repeated basis, they're down on a position, they won't sell it. And sometimes you just got to let it go because it's not working. It's not working for a reason. So learn to accept losses. 9 times out of 10, the leaders in advance make new highs ahead of the averages. So watch the stocks that are leading the market. What stocks were leading the market yesterday? Right? The ones that have been under the most pressure, but they're also the ones that have the biggest earnings growth. Those rules, though, all 12 rules are in the article. Go to the website, realinvestmentadvice.com. Download the article. Is the correction over? It's the blog post for today. It's also on our Substack, out this morning already. If you're following us on Substack at Lance Roberts, all of our articles get posted there, as well as our morning market commentary. That is out also. All right, when we come back, we'll pick up with John Penn. He's got a few things to get into this morning. Don't go away.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
By the way, I'm very disappointed in you and Richard, both.
I can't
very
wait to hear why.
Because I was online yesterday and got an ad that popped up, and it's for a new book that's just come out. It's called I'm Sorry I'm Dead. That's the name of it.
The Real Investment Show podcast.
So when you pass away, all the people you need to contact. And, we told our kids that when my wife and I pass away, we want them to cremate us and then take us to Italy and dump us in the ocean in Italy.
At realinvestmentadvice.com.
Knowing my kids, I don't trust them, so I may have to have a third party kind of make sure we get to where we're supposed to be.
A trustee of ashes?
Exactly. We got them as far as Galveston.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, kind of big news over the last couple of days or so is that Italy is now going to be shipping us millions of eggs.
Millions
of eggs, because they're going to help us with our egg crisis. And the problem is now that egg prices are absolutely plummeting. So
just in time.
So by the time the eggs get here, we're going to have deflation in eggs because we will now have too many eggs on the shelves. Orange juice prices also collapsing as well. So a lot of those concerns that people have. Have you seen the price of orange juice lately? Yeah, well, it's coming down.
Talk about movies. Talk about trading places. That's what's coming to mind right there.
Exactly.
Tell them to sell.
You should come to the studio next Tuesday and wear a gorilla suit.
You want me in the gorilla suit? Okay, sure. All right.
Why not?
Why not? John will do it.
John will do anything. Mikey likes it.
He'll put on the gorilla suit. Okay.
How are you this morning?
What's that?
How are you this morning?
I'm good. I'm distracted now. I've tried to go find a gorilla suit. No, I'm good. You were talking a little bit in the last segment about the market pullback and just sentiment.
Yeah.
And I feel very blessed that with what we do on any given day, we speak with a number of folks all over the country. East Coast, West Coast, middle of the United States, folks that split time between U.S. and the internet. Talk about Italy. A lot of folks want to kind of split time between living in the U.S. and living in Italy. But it does seem that just even with a 10% pullback with the market as of late, and we talk regularly how about a market move of 5 to 10% up or down is kind of normal market behavior. But just with this recent pullback earlier this year, Lance, I mean, it feels like sentiment just kind of across the globe, at least with folks that I'm visiting with, it's very depressed. Mm-hmm. Right, it's like it feels worse than what it really is. Yeah. But when you look at portfolios, if your portfolio is balanced and if you have bonds in your portfolio, we still have treasuries in the portfolio. Your portfolios weather this market volatility really well.
Right. Well, again, we've talked about before. There's a huge difference between, and I always find this fascinating, right? Especially when talking to clients or even prospects.
Yeah.
There's a huge gap between what's actually happening in the market versus what they think is happening in the market.
Exactly.
Because of what they see on social media, what they see in the media itself, not just social media, but the media itself. You got all these videos coming out. The market's crashing, and we're heading into the next bear market. Whatever it is. Market's down. What is the biggest decline in 15 years? Whatever. It scares people, weighs on them emotionally.
It does.
And interestingly enough, it's very fascinating to me is that people have a lot of money invested in markets, but they don't know how to read a financial statement. They do not know how to read the statement they get from their bank or their brokerage firm. I mean,
yeah.
And it's very fascinating to me. It's like, okay, you own all these stocks, you've made all these investments, but you can't read your monthly statement or your online statement, whatever it is. And it's very fascinating. It's how that disconnect happens.
Well, and it kind of goes back to the know what you own, right? Like why? So I mean, still to this day, there are a number of folks that I visit with. They're more prospective clients at that point where they have this collection of investments. It's like a collection of Beanie Babies in their portfolio. Mm-hmm. And John, I don't even know how I got all this stuff, but here it is. It's like, okay, well, did you buy this on your own? Well, some of this was recommended to me from a neighbor, from a friend, and I just put a little bit of money into it. But then, of course, when markets get volatile, if you don't have a really good understanding about what you own and how it's going to behave, no wonder why you're stressed.
Well,
right?
But also too, it's a function of, I own this, it's down, or it's up, or whatever it is. A good example, a really good example is bonds. Right? Great examples, bonds. I mean, somebody owns a bond and it goes down in price, but they don't understand that you're also collecting cash income from that. So you've got to calculate that back in. That's what I'm saying by reading your statements. You've got to understand what's on that line item on the statement, what's it saying versus what's actually happening. Mortgage-backed bonds are the worst, right? Because all they do is decline in price the whole time because you're getting principal and interest payments back every month. But so you got to calculate those back in. It's very difficult to, it's very difficult to understand that when you're just looking at a line item on a statement. Or just because a singular line item on your statement is negative doesn't mean your whole portfolio is bad. Right? It just means you have a bad position. Potentially, you've got an equity position that's falling out of bed, whatever reason is. Doesn't mean the whole portfolio is bad, right? And so it's fascinating. People just focus on singular issues rather than looking at the portfolio as a whole. It's kind of like your car is misfiring because you've got a bad spark plug, so you just trash the whole car.
Or rip out the whole engine.
Exactly.
And all you have to do is just repair one plug.
Right.
Yeah.
But that's the way people view their portfolios. Not like, it's one position, so my whole portfolio is bad. No, it's just you've got to understand what you own and understanding how to read your finance. We probably need to do a whole show.
We probably could. We could.
Just on how to read a brokerage statement.
Yeah. And, and it's just amazing too. I mean, headlines, there's a lot of scare tactics out there right now. So you got to be really careful about letting these headlines really influence you into making what I would like to call a knee-jerk reaction with your portfolio that could be detrimental. So last year, it was like nobody wanted bonds. Nobody wanted bonds. And this year, it's like folks can't get enough. But then as of late, so it's just amazing how the pendulum swings. Last year, nobody wanted bonds. This year, why don't we have more bonds in the portfolio?
Now I don't want bonds again.
So now, like over the last week and a half, I can't tell you how many conversations I've had where folks are scared that, are U.S. Treasuries still a solvent investment to have in the portfolio because they're hearing headlines out there about how maybe foreign countries are no longer buying U.S. Treasuries.
Which isn't true.
Right. But if you hear that, if you don't investigate that, if you don't take a look under the cover and really look at the research and look at the data, it could force you to make a decision that doesn't make sense for your portfolio. I mean, if you go back, so I pulled the chart. Michael Leibowitz on the team here. I went to Michael and said, "Hey, Michael, can you pull a chart or pull the data from the U.S. Treasury showing me, hey, countries, how many of them are buying U.S. Treasuries over the last 12 months?" And if you look at the history from January of 2024 through January of 2025. Foreign countries are still net buyers of U.S. Treasuries. As a whole, those foreign nations have bought an additional $570 billion of our U.S. Treasuries over the last 12 months. So if you see these headlines that go, the Treasury markets, you don't put it in your portfolio. This isn't the place to be. U.S. Treasuries are not solvent. It's just simply not true. Right. So you got to take a deeper dive and to look at this stuff a little bit closer sometimes.
Well, it's just, we had this, I was writing some articles right at the end of last year because, we had James Grant and then you had Paul Tudor Jones come out. I was like, I wouldn't own treasuries in my portfolio. And I mean, you could not have top ticked the bottom in bonds any better. Right. I mean, just when those articles hit, that was the bottom in bonds and they've been rallying, this year so far. And look, they're going to go up and down.
Yeah.
Right. They just we talked about 2 weeks ago, they were extremely overbought. You're going to get a correction in bond prices. And that's what's going on here because technically they were just grossly overbought. But economic growth, inflation, all those type of things are now lining up to support lower yields in the future. In fact, we're just talking about, egg prices and orange juice prices declining. One of the primary indicators for disinflation is when the University of Michigan, or you take these consumer sentiment indexes of inflation, get above 5%, which they just did. Those have always been the peak of inflation. It's because, again, it's sentiment, right? I'm asking John, how do you feel about inflation? It's just too high. That typically bends and then what do people do? Well, they start cutting back. And if you take a look at default rates on credit cards, default rates on auto loans, you take a look at delinquency payments on mortgages, et cetera, those are all starting to sharply rise higher. which is showing you that the consumer's under stress. So you're going to get slower economic growth, which leads to disinflation. So
yeah, it looks like more and more folks are, there's an increase in the number of 401k plan participants that are actually tapping their 401k plans for emergency funds as well.
Yep.
So we're seeing that trend as well. I think last year it was 3.6% of participants, pulled money out of their 401k plan for an emergency fund purpose. This year that's up to about 4.6, 4.8%. Not a huge difference, but it's still, it's still an increase in folks pulling money out of 401k plans. So you are starting to see a little bit of signs of maybe a little bit more stress on the consumer.
yeah. No, and look, I think that's logical.
Yeah.
All the money that we were sending to people, all the the moratoriums on payments, et cetera, that's all run the course, right?
Yeah.
And look, and inflation was running high. Yeah, it's slowly coming back down, but it's still the cost of living still remains, pretty onerous on 90% of Americans. We talked about that chart last week, which showed that 10% of Americans, make up 50% of the spending in the economy. That bottom 90% is just struggling to get by, right? And so that, and again, the top 10% may be driving 50% of the spending, but 50% of the spending is driven by the bottom 90%. So you can't discount them, right? And if they slow down significantly, that's going to lead to slower economic growth. Doesn't necessarily mean a recession,
Right.
but it certainly doesn't bode well. And if you get another couple of sharp declines in asset prices that begin to weigh on the top 10%, they're going to cut their spending too, right? So there's certainly some risk there. So we'll see.
Yep.
We'll see what happens. All right, so when we come back from the break, we're talking a little bit about, we get this question a lot of, we talk, about taking profits, rebalancing portfolios, those type of things. We get a question a lot about, well, what does that mean? Typically, when I say take profits, people say, oh, Lance said take profits, so I sold everything. That's not what we mean. We'll talk specifically about how to look at your portfolio and learn how to take profits and go through that process. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So John and I were just visiting off air, and this is a story I meant to. We're going to get into taking a profit here in just 1 second, so just sit tight. But John and I were just talking off air, and this is a story I meant to cover, and I forgot. It slipped me because 23andMe, which was the DNA testing company, which is always interesting to me because it always had a finite life. This was not a company that was ever going to have a sustainable life because once you test your DNA, you don't ever do it again. It's not something like, I need to get a regular proctology exam, right? It's like where you have to go back and repeat something over and over again. It's like I test it once and great, I know my history and I've given all my data to the government. Now they know everything about me. So it was always a finite business for me, and that's why we never invested in it. But it was interesting because 23andMe is now basically an FU because they have filed bankruptcy.
And I just got mine in just in time. So I'm one of those subscribers. So I walked right in. We were talking about 23andMe during the break because I saw an ad about it. I was like, I just got my DNA test results back. And, you can get in there to the app and upgrade your premium and do all these things. I'm like, well, I don't want to do that.
Yeah.
Why would I do that? Okay, and it really wasn't even my idea. I mean, my wife, Shauna, bless her heart, she's like, we need to look at this. We need to do Well,
that's because we're all pretty convinced your tree has one limb.
Is that
so it? Shauna wanted to prove us wrong.
I appreciate that. Wow. First, it's the gorilla suit. And now my tree has one limb.
Well, I mean, you folks from Arkansas.
I think I'm going to come in here. Arkansas? What? Nothing against you, Arkansas. We love you. All right. So, hey, a lot of folks listen to our show in Arkansas this morning. But it's getting a little thick in here. But yeah, so the real reason she wanted to, well, we even bought a 23andMe kit for my mom and dad, and guess where that thing is? It's sitting on their back, coffee table somewhere as a coffee coaster. I don't think they even used it. So anyway, hence the point about poor 23andMe. So
yeah, 23andMe is now filing for bankruptcy. They tried to have several takeover offers, and this is also one of the really, when you have a bad board running your business, they had several buyout offers. And each offer was getting progressively worse because the stock price was declining and the future of the company was becoming inevitable. So people that were willing to step in and buy the company were like, "Yeah, I'll give you, $100 million for it. I'll give you, $50 million. And now it's basically zero at this point." So, but anyway, 23andMe is going into Chapter 11 bankruptcy. We'll see if they emerge out of this. Maybe somebody will take them private. Again, it's one of those issues where I'm pretty sure the CIA was like with Google and a lot of other companies, the CIA kind of funnels money into them. And in order to get data from them for data collection purposes, I'm sure that 23andMe had some, relationships with the government somewhere for data collection.
If that's the case, the CIA has me in their database now. Right?
Of course. They have everybody.
And in the notes field.
This is always the interesting thing, right? People are like, oh, you have to be so careful about everything, right? The government has, this. And then every time you want to buy something, you give people your social security number, your driver's license number. I mean, they already have all your data.
And now in my CIA file, there's a notes field in there. He likes to wear gorilla suits. I'm telling you.
Exactly. And he has one family branch.
Man.
So it's in there. So yeah, the government already has all your information. Stop worrying so much. I'm going to live off the grid. Okay, great. You go live off the grid. Government still knows where you are. They have satellites. So anyway, let's talk about taking profits.
Sounds good to me.
Yeah. So one of the questions that we get, most of the time is simply, we talk about taking profits. And as I said in the last segment is that when I say take profits, people immediately assume, oh, that means sell everything. That's not what taking profits means. Taking profits means just taking some of the money that you made, taking the profit on a trade, taking that off the table. Selling losses are the same way. So, if you've got a loser position in your portfolio, you sell it, right? You don't, it's like I've got to make a decision. And again, we go back to our 12 rules from Gerald Loeb in today's article. Accepting losses. Rule number 3, accepting losses is the most important thing. 9 times out of 10, the leaders in advance make new highs. So I don't want to sell when I say take profits, that doesn't mean sell all of your stocks that are winning, right? Because the ones that are leading a rally tend to be the ones that make new highs. So it's just a function of rebalancing your portfolio to a degree and looking at positions. So again, how do we do this, right? Is there I think the question you get, John, is there like a rule of thumb?
Yeah, is there a rule of thumb, like how much? So talk a little, how much to trim? Is it the same every time? Does it really depend on what the actual investment position is, if it's a stock or a bond or an exchange traded fund? So maybe if you could, Lance, could you talk a little bit about from an individual stock standpoint, is there a certain target weight that you and Michael look at to allocate to a position? And then depending on how that position moves up or down, does that determine the amount that you trim from a profit or loss standpoint?
Yeah, no. Look, first of all, this is just our process.
Got it.
Right?
Yep.
So, everybody does stuff different. William O'Neill has written a numerous number of books about investing and how to make money in the markets and those type of things. Great books, right? So anything by William O'Neill, highly recommend to read. But for instance, he recommends an 8% stop loss. The problem with an 8% stop loss, using a percentage in today's market of any sort, right? I don't want to lose more than 5% on a position. I don't want to lose more than 10% on a position, whatever it is. The problem in today's market is that the market moves so fast that a set percentage will trigger you out of losses or trigger you out of positions normally like right near a bottom. So again, we just went through a fairly, 10% correction in the markets. We broke the 200-day moving average, right? Then that's one of those kind of cardinal rules. You break the 200-day moving average, you're out of your position. And like we said before, you've got to be careful with that because there's so much psychology tied to the market now. We have all these computerized trading algorithms, everything else. They're hunting those stop losses, right? They're hunting those levels where stop losses are lined up in the market. So if you're looking at, so I've got a 5% stop loss, so I'm going to put that in there. I'm going to put it in my computer. These computers are looking at that, right? We were just talking about 23andMe and all your data. Everything you do in the stock market, all these computer algorithms it's what we call hunting losses. They look for these stop losses that are out there and they hunt those stop losses. They drive prices down to those levels where all the sellers are sitting. And they trigger those sellers to sell their positions, and then they start buying the position. That's why you get these big reversals in the markets. That's those algorithms coming back into work and saying, I just got all your money, and now I'm going to go make money with it. And so that happens a lot. And so you've got to be much more careful about how you manage this. But we talked about previously, and the way this is how we do it, and again, how you do it is there's nothing wrong with the way you do it, unless you're not doing it at all. So,
yeah, great point. Yeah.
Or if you're, when I say take profits, you're selling the whole position. We weight everything in our portfolio based on volatility. So when we buy a position in NVIDIA, it has twice the volatility. I'm just making an example here, right? So don't quote me on this. I'm just easy math. NVIDIA has twice the volatility that Visa does. Visa doesn't move around a whole lot, right? So it trades closer to the market. Market's up 1, it'll be up 1. If the market's up 1, NVIDIA will be up 2 or more, right? So the volatility is an important role, or the beta of a position is an important factor in determining how much of a position we own in the portfolio. So if our maximum target weighting for any position is 5% in the portfolio, and a position has twice the volatility of the market, the max position size I can have in that position is 2.5, because it trades at twice the volatility as, in this case, NVIDIA trades at twice the volatility as Visa. So I can hold a 5% position in Visa, but I can only hold a 2.5% position in NVIDIA because of the speed at which it moves within the portfolio. So when I look to take profits, if NVIDIA has grown to 3.5% of the portfolio because it's been going up in price, and again, these are all just hypothetical numbers, so don't take these as absolutes. But if NVIDIA has grown to be 3.5% of the portfolio because it's up sharply relative to Visa, then I reduce that. I take profits. I reduce that position size back down to its target weighting. So I go from 3.5 back to 2.5. Take those profits and let the principal portion ride. And we've been doing that over the years that we've owned NVIDIA. So we don't have any capital in NVIDIA. You know, if you were in the one of the original holders of NVIDIA in our portfolios, you no longer have any of your actual principal in that because we've taken all that principal out of that position. So we're strictly trading on market money with NVIDIA right now. So if it goes to zero, it doesn't impact principal. But in the same vein, you know, if I have a loss position that's working, then that's where I'll go in and say, why is it not working? And again, so good example of this is we bought Arista Networks recently. We added that to our portfolio. It was in the middle of the correction and it was going down. So we bought a very small starter position in that stock because we didn't know where the bottom was. So we bought a little bit of that position. As the market started to bottom here recently, we added that position, lowered our cost basis, and then it's been rallying the last few days. So now we're into a profit position in that portfolio. But by working our way into that position and building it to its target weight, it allowed us to lower our cost basis on that entry. So now when the stock rallies, at some point that it's got a 2% weight in the portfolio as an example. If that position grows to 2.5 or 3, we'll trade it back to 2, right? Take those profits, let the principal continue to ride as long as we want to own that position. So again, there's not a set rule of thumb, but really what it comes down to is you need to establish target weights in your portfolio for each position and then trade around that target weight. And it'll help you be a better long-term investor because you have a better understanding of how your portfolio is constructed. And also don't let a position be so big that it destroys your whole portfolio if it goes to zero, which, as with 23andMe, can happen. Have a great day. See you back here tomorrow.